by way of introduction. So, well, welcome to mock exam 5. It's nice to have us here. We are looking at a company into telecommunications, Magic Network Communications Limited, as we can see on the screen. Okay, so the company has a number of subscribers, and we have the exhibits in the pre-scene that includes 4 exhibits in the pre-scene, and we also have the unseen, which includes 1 exhibit in the unseen. So we're asked to provide advice to the board on 1 or 2 issues in their operations. Okay, so as you can see on the screen, you are Chika Ahmed, a partly qualified chartered accountant with 1 paper left to complete the final level of the professional stage of the ICANN exams. And our role, or your role, is associate analyst, and the name of your firm is Phoenix Adele Global Partners, an accounting firm or accounting advisory firm based in Lagos, Nigeria. So MNC provides telephone and internet services to the Nigerian telecommunications market. The company is fast growing and has significantly increased its subscriber base since it began operations 6 years ago. After being granted operational license, the Nigerian Communications Commission, the independent regulatory body for Nigerian telecommunication industry, are responsible for granting operational license, granted them license. Okay, so we got an email from the partner of the firm, Muri Adela, and the finance director representing the board sent that letter to us. Okay, so these are the list of exhibits. We have the email from the partner to you, that is you in the case, Chika Ahmed. And exhibit 2, we have the letter from Adeshua Thomas, the finance director of MNC. We also have an extract of the chairman's statement from the annual report of MNC for 2015. We also have the financial information extract of MNC Limited for the years 2024 and 2014 and 2015. So those were the documents that were provided in the pre-scene. And worthy of note, we just look briefly at what was provided in the exhibit. So the email of exhibit 1 was talking about the interaction between the partner and you. So take note of something, an ethical concern that was stated in the final note of that exhibit, of this interaction or this email. He said, finally, I have just learned that MNC is in breach of some regulatory requirements in its operations, and as a result have been fined a substantial sum of money for its non-compliance. So you can note an ethical issue here from exhibit 1. And we understand that MNC intends to contest this in court, but it's rather worrisome that Adeshua Thomas, the finance director, failed to mention this during our meeting. It is surely an information we should put in the know, because there are rumors that the CEO is seriously considering tendering his resignation as a result of the matter. I got to know about it just this afternoon from Kunle Eson, the former chief auditor of MNC, and he also mentioned another problem about the state of low staff morale at MNC, especially due to the long hours being worked without additional incentives for such efforts. So our partner has brought this to your attention, you that is Chika Ahmed in the case. So take note of that. It's an ethical issue. This is an ethical issue, and don't forget, the examiner is keen on you writing on ethical issues. The ethical issues should be properly identified, and it carries 10% of the marks for the exam. So ethical issues must be stated in the same section with your application of professional skepticism. So please don't forget to take note of that. Now, Exhibit 2, as you can see on the screen, was the letter from MNC to the partner, your firm, your audit firms or accounting firms partner, Mori Adela. The document talked about the chairman, the projects, the customer focus. It talked about the complaints for the period, talked about strategic planning, talked about training and development costs, and it ended like that. So you could see that the finance director truly did not talk about the ethical issue that the auditor stated in the first exhibit. Okay, so the third exhibit is the chairman's statement talking about their performance, how they grew the customer base by 40%, and also the profit that also grew from 19.6 billion naira to about 28.45 billion. Now, also they talked about the languages used by 92% of the country's population, in addition to English and French. Also, you will see that the business development area experienced growth, corporate development, talking about the people and the future outlook. The chairman was optimistic that they were going to do better in the following financial year. Okay, so having looked at that, we'll now talk about the financial statements that was presented to us in Exhibit 4. So you can see their statement of financial position at a glance on the screen. So worthy of note, you should take note of the current assets. There were no inventory. So it's a telecommunication industry or a business, so there was no inventory recorded. Take note of that from the financial statement. And look at their non-current liability. There's a mixture of debt and also their capital is taken note of. All right, so the statement of comprehensive income also shows their revenue, their cost of sales, the gross profit, selling, distribution and admin expenses, their profit before tax, and their taxes, and the profit for the year, all in billion. Also, they have the statement of changes in equity, the movements in share capital, premium, retained earnings, other comprehensive income, and the dividend. There was no dividend declared for the period, and also a prior period adjustment of 1.2 billion. And also, very relevant information here is the cash flow from operations based on the number of subscribers that was increased from 2014 to 2015. Also take note of that. MNC also embarked on two projects, Project Venice and Project Oluno. We were shown that the net present value of both projects were positive, 201 billion, and the other was 107 billion. Both Oluno was in 2014 and Project Venice was in 2015. We see that initial investment was 190 billion for Venice, and for Project Oluno, the initial outlay was 85 billion. The return on capital employed was about 29% of 190 billion, while that of Project Oluno was 31% of 85 billion. You see the number of years of both projects was 5, the discounted rate was 10, while the probability index was 1.06, 1.26. Okay, so that ended the pre-seen document, and we had the unseen document that came up with another exhibit, which is Exhibit 5. And the Exhibit 5 showed us the type of services and the queries that were received. Now, we always are aware of mobile telecommunications where you have issues. You pick up your phone and you call their free toll number to complain. So, the kind of services that customers or clients, subscribers were calling are here on the screen. So we have 4 of them. We have the mobile telephony, which is MT. We have MIS, which is the mobile internet service. we have home internet service, and we have business internet service. So we could see on the screen the demand, which is the number of queries people call the call center for. You also see the operator minutes per inquiry. So for each minute is stated there. For MT we have 16, for MIS we have 12, and for home internet service we have 12 also. Then for BIS, which is business internet service, we have 6. Now for the consultant minutes per inquiry, you will see for MT 0, for MIS 8, and home service 28, and for business internet service 54. Okay, so there's an information here about the total number of staff which we're operating the call center. We have them at 185. Now 100 of those 185 work 15 hours per day, while 85 are consultants, also work 15 hours per day. And for each hour they were paid 60 naira for operators. Then for consultants, they were paid 19 naira per hour. So both operators and consultants are required to take a mandatory 1 hour break each working day in that 15 hours. All right, however, with a relevant insignificant cost of training, an operator can be transformed into a consultant. So there is a conversion possibility here with a resulting pay rise. Consequently, a consultant can be transformed into an operator, but there is no decrease in pay. So take note of this also. An operator can be transformed to a consultant with a significant pay rise, but a consultant that is transformed to an operator, there is no pay rise. So please take note of that. Okay, so pricing of call center service information is provided below. So the above you see here are the number of queries and the cost, while the price is normally, if you call, there is a cost attached or a price attached to that call. So each call for the type of service is 40 naira for MT, then 220 for mobile internet service. Then for home internet service is 180 naira, while for business internet service is 300 naira. All inquiries for the service provided are charged automatically to each customer's account. Okay, so what is our requirement? Number 1, now we are required, using the information in the attachments and the exhibit, to draft a report to the board of directors. We are to state 1, an analysis of the strategic performance. Take note of that. Strategic performance is different from financial performance. So analysis of the strategic performance as part
We can't hear you, sir. We can't hear you, sir. It's breaking, sir.
Apologies. I'm back now. That was network glitches. I hope you can hear me.
Yes, we are okay now.
We can hear you very well. Yeah.
Oh, okay, fantastic. All right, so we are expected to take into consideration the comments of the chairman in this statement, that is Exhibit 3, and the relevant financial information provided in Exhibit 4. Exhibit 4 is the financial statements, the statement of financial position, and the statement of comprehensive income. We are supposed to use that to come up with suitable ratios that you deem meaningful in MNC's industry for your analysis. Now to tweak the question again, based on those ratios, in that same requirement 1, the examiner said we are expected to use balanced scorecard again for our analysis. So in this question, he added a model to requirement 1, which was not usual. Usually he normally brings model analysis in requirement 2, but he added to that financial performance he said we should assess, and the strategic performance he said we should add model analysis. So after doing your ratio analysis, you still use the model to speak to the ratios on the strategic and financial performance of the company. So it's a bit dicey, The question is quite tricky. It's not easy, but I think it's simple, especially if you are aware of the four components of the balanced scorecard model. Okay, so that was for requirement 1. Then requirement 2, he asked us to do an analysis and determination of the product mix that will maximize the margin of the company if no staff was to switch position between the consulting and the operating arm. He also asked us to calculate the total margin from our suggested product mix, which was provided to us in Exhibit 5. Secondly, based on the product mix he asked us to do, he now asks us to advise on how to allocate the existing staff between the operator and the consultant's role in order to satisfy the market demand, working with the assumption that MNC cannot hire new call center staff. So those existing staff are the ones that will do the work. So our assumption is that they cannot bring in new staff from outside. Now, he said our advice should also include other business and managerial factors that should be taken into account when considering our recommendations. So he now said your report should also concentrate on key figures and issues and should provide a clear explanation or explanatory commentary together with our judgment and conclusion on the key items which we have identified. So take note of that. So the requirement is dicey, and he pimped both requirements, especially one with the balanced scorecard with that of number 2 that has to do with contribution and marginal costing approach to attempting the question. Okay, so let's
You're off again, sir. You're off, sir.
apologies, ACAs, don't mind MTN, I'm having some little glitches. Please confirm if you can hear me.
You're back now, sir.
Okay, I'm back. Apologies, I'm having little network glitches, but it's back. It's going off and on. Okay, thank you for that. So I was talking about balanced scorecard model, and that is the first thing we should be able to address, the balanced scorecard model. What is the model about, and how do we use the model to speak to the case at hand? So the first thing is identification of the model. So the balanced scorecard model has 4 components, looking at the financial aspects of the business. What are the financial objectives of the business? What measures are the business taking financially? What targets do the business have financially to meet? And what financial initiatives can the business use to meet those targets? So the balanced scorecard model, to succeed financially, we must look at the objectives first. So financially, from your budget, from your forecast, what do you intend to achieve? So the first component of the balanced scorecard model is your finances. So the second aspect of the balanced scorecard model is the customers. So aside what you want to achieve financially, who are you bringing this service to? Whose problem are you solving? A business is about solving problems, bringing value to somebody. So who are you trying to solve their problem? So we must be customer centric and customer focused. What are the objectives of our customers? What measures do our customers have, or do we have, to ensure that they are satisfied with our product or our service? What customer targets do we have? The numbers of subscribers, especially in the case of our telecommunication business. The chairman mentioned how they grew by a particular number. So The customer focus is looking at the targets you have and the initiatives you have and how to achieve this vision, how you can appear to and satisfy your customers. This is very essential. While the third component of the Balanced Scorecard model is learning and growth. How do you learn internally? Stakeholders, staff, management, the board. How do you learn? What are your targets? What are your objectives of learning? What measures do you carry out to learn? What are your targets to learn year in, year out? Short-term and long-term learning goals. What initiatives can you bring in your learning journey? So to achieve your vision, how will you sustain your ability to change and improve? And that's what learning is all about. Learning and relearning, changing and improving. Change management is very important in every organization. So, and that's what this third component of Balanced Scorecard is talking about. So you have a customer and a financial component to meet. So how does your learning curve help you to meet those two perspectives? This is very important. Okay, and finally, we look at the internal business processes. So the objective of internal processes, accountants, we call it internal controls, how you satisfy your customers, and what processes do you have internally to ensure that you seamlessly meet your customers' needs. This is very important. So internal business processes help you excel in your vision and your strategy, especially in every business that provides products or services. So these are the 4 components of Balanced Scorecard, and to succeed, you need to integrate these 4 components into the company's financial strategy. All right, so in the little time we have before we go and pray, let's look at the business or the financial position. Let's look at the financial position of the business. So if you look at the financial statements in the pre-scene, you will see the statement of financial position is a bit robust. The 2014 and 2015 revenue, their cost of sales, you see their gross profit, their selling and distribution, profit before interest and tax. After they've deducted tax, you also see their profit for the year. Okay, so to have relevant ratios, when you hear strategic or financial performance and ratios that deem fit, like the examiner said, so we should be able to calculate for financial or for profitability, you should be able to talk about 3 or 4 ratios. So you talk about gross profit margin, you talk about net profit margin, where necessary you talk about return on capital employed, you talk about return on equity. So if you're not given the specific ratios to talk about, those 4 will suffice for profitability ratio. While looking at liquidity, you note that from the financial statement there is no inventory, so we cannot calculate asset test ratio. So we could just calculate current ratio, and we could also calculate cash ratio, since we have cash and cash equivalent. So those 2 ratios will suffice for liquidity, and we have 6 ratios. Then for a long-term solvency, we could just calculate our debt or our gearing ratio, our debt to equity ratio, our debt ratio, and our also equity ratio. So those 4 will also suffice. Let me come again. We could calculate our gearing ratio, our debt ratio, our debt to equity ratio, and our equity ratio. Equity ratio is also known as proprietary ratio. Okay, so having looked at that, let's look at the growth in their revenue stream. Let's look at the growth in their revenue stream. You can see revenue grew by 114% between both years, but also you see that the cost grew by 118%. So to provide the service or to attract or grow their revenue, they had to attract a cost of sales of almost the same percentage or even higher. You see their gross profit grew, and also their selling, distribution, and admin also grew by 140 almost percent. But then their profit before interest tax was okay at about 44% or 45% approximately. You could also see that their profit for the year was about 44%, and this is after they've deducted taxation. So fairly from the financials, it looks like the company is doing well. But then professionally, we need to be skeptical about the figures, because there was nowhere it was stated that this financial statement has been audited by an audit firm. Okay, so ladies and gentlemen, it is 7:40. We'll stop. I'll go back a little bit on what I was saying before we went on the short break, talking about the requirement on the financial aspects of the requirement. So the examiner asked us to come up with suitable ratios that we deem fit meaningful in MNC industry for our analysis. So like I said, we could calculate our gross profit margin, net profit margin, return on capital employed, and return on equity, which are essential ratios. But from the screen, you can see the examiner prepared just 3 ratios for profitability, 1 ratio for liquidity, and he prepared 3 ratios for short-term, long-term solvency. So anyone we prepare, like I said earlier, will suffice. So if we prepare 4 for profitability, 2 for liquidity, as we can see, the current and the cash ratio are the only relevant ratios we could prepare based on the financials that was given to us. So it's very essential we take note of the financial statements and prepare ratios that are relevant based on that. So it is practically impossible to prepare quick ratio, because if you can see on the screen, you will see that there is no inventory in this telecom business. So they don't have, they don't keep inventory of any kind. So it's essential, and we know that we cannot prepare the acid test ratio. So the current ratio and the cash ratio will suffice, but you could see that the examiner only prepared current ratio to access their liquidity position. Okay, so for long-term solvency also, you will see that the examiner prepared just 3 ratios: the gearing ratio, the equity ratio, which is also proprietary ratio, and the debt ratio. Please take note of that in our further analysis or latter requirements. Okay, so having spoken about that, you will see that we have a total of 7 ratios calculated by the examiner. So even if you calculate 4 for profitability, 2 for liquidity, and 3 or 4 for long-term solvency, it still makes a lot of sense. All right, so having said that, let's look at how the ratios were calculated. So the gross profit margin is a general ratio, is a simple ratio in my opinion. Looking at the gross profit divided by your revenue or your sales by 100, or expressed as a percentage. All right, so for 2014 we have the revenue or the gross profit margin at 19% approximately, and in 2015 we have it at 17.5%. So the gross profit margin dropped as a result of high cost of sales that was injected into getting that amount of revenue that was reported for 2015. Okay, so the net profit margin was calculated as profit before interest and tax, which in my opinion is not correct, because your net profit margin should be your bottom line, which is your profit after tax. Your profit after tax. But then the examiner used profit before interest and tax just to see the internal generation of the internally generated organic income. But then the standard practice is to calculate net profit after tax. But if you use net profit before tax, well, I don't think you'll be penalized, since the examiner used it, and that was what I replicated in the Pathfinder. But then the standard formula for net profit margin is profit after tax divided by your revenue, expressed as a percentage. So he used profit before tax, but then if you use profit before interest and tax, you will not be penalized. That's what he's saying. But and the standard formula for net profit after tax, for net profit margin calculation, is profit after tax. So You could see that in 2014, based on the formula used, it was a bottom line of 88%, 8%, while in 2015 is 5.5%. So if you use your profit after tax, you will see that in 2014 it's about 5%, and in 2015 is about 3%. After you've recognized internal and external expenses, which is the correct calculation to employ. Okay, so the next formula he used, or the next ratio he calculated, was return on capital employed, which is the correct profit before interest and tax, and also your capital employed is your debt and your total equity. Your debt and your total equity. So going back to the formula, you will see that our debt is about 168 billion naira. Sorry, our equity, our total equity is about 168.4 billion, as you can see in the screen, on the screen. Then our debt, which is our non-current liability, is 80 billion. So 80 billion plus 168 billion will give us a total capital employed of about 248.42 billion. While our profit before interest and tax is about 28.45, while 19.68 is for the period 2014. So I believe the profit, the return on capital employed is fairly calculated, and it makes a lot of sense. So if we want to use the other derivative for the capital employed, we could also say our total assets, which is 354 billion, minus our current liabilities, which is 57.09 billion. So if we do that, we should be able to arrive closely at what the examiner got as per the capital employed. So 35409 minus our current liabilities, which is 105.67. So we have a total of 248.42. We have virtually the same thing we have when we calculated the equity and the debt. Exactly the same figure. So whichever way you calculate it, total assets minus current liability, or your total debt plus your total equity, you also have the same figure. Now you see that the return on capital employed for 2014 was about 13.2%, while in 2015 it was about 11.5%. Take note of that. Okay, so for current ratio, measuring our ability to be able to settle day-to-day transaction and our short-term liquidity. Now you will see that the current assets is about 57.56 billion in 2014, while it dropped to 57.0 in 2015. While their current liabilities was about 73.41 billion in 2014, while it moved significantly to 105.67 in 2015, showing that their current liabilities are a bit more than the current assets. Okay, so you could see that from the current ratio in 2014, 57.56 divided by 73.41 is about 0.8. That's about 80% of the current liabilities, which is not covering it up to 1, indicating the company has a little liquidity issue where their current assets is not covering their current liabilities. That means they have working capital challenges, a bit of working capital challenges. Normally you should have your current assets to be about 1 time above your current liabilities. All right, so it further deteriorated into half in 2015. You could see their liabilities increased, and this could indicate tying down amounts in trade receivables or other receivables, and also the inability to pay creditors on time could be the challenge with their working capital management. So take note of that. So in 2014 it was 80%, while in 2015 it was half. Current asset was half the current liabilities, which is not a good working capital position for the company. All right, So having looked at that liquidity ratio, let's look at the long-term solvency in assessing their performance. So we look at the gearing ratio, which has to do with your debt divided by your total capital, your debt divided by your total capital employed. So the debt from the financial statements, you'll see that the debt is about 80 billion, while the equity and the debt combined is 168.42 plus 80 billion. So you'll see that from the gearing, the company is lowly geared. Why is it lowly geared? Because in 2015, you'll see that the debt is about 80 billion, while the capital and the total capital employed is about 248.42 billion. So the company is lowly geared in the sense that debt is lower than the total exposure of the capital. So 32% of the debt comprises of the total capital the company has in running the business, which is fair enough. All right, so let's look at the equity portion or the propriety ratio of the company. So the equity portion is calculated as our total equity divided by our total assets, or you use your total capital. Any of the two suffices, but the popular ratio you use to calculate equity ratio or propriety ratio is your total equity divided by your total assets. Okay, so looking at the equity from the financial statements, you'll see that it's about 168.42 billion, while your total assets, or the total assets for the company or total capital, is 354.09. So any which way you decide to take it, whether the total capital or the total capital and total liability of the company is the same. So if you add your total liabilities plus your total equity, still we will arrive at the total amount of the assets. So if we say our equity, which is 168, divided by our total assets, we have it as 47% of our total capital in the company. So 47% of our capital in 2015 is what the equity holders have. While in 2014, 67% of our capital is what the equity component represents. So you can see there is a drop. There is a drop between 2014 in shareholders' funds, in shareholders' equity. There's a drop. So I'm sure there was injection of capital flowing back of profit to the company in 2015 as against 2014. Okay, so for debt ratio that was calculated, our debt is divided by our total capital, just in the case of our equity or propriety ratio. So our total debt is about 80 billion, then our total assets is about 354, the same thing we used to calculate the equity ratio. And you'll find out that in 2015, the debt was about 22%, but in 2014, there was no debt. The company just subscribed or had to request for external funding in 2015, I'm sure, to expand the business. So in 2014, there was no debt. Also, the company had no debt. That's why there was no calculation of gearing in 2014. So the gearing came about in 2015 financial year, and it's because the company wanted to expand. Remember in the exhibit we talked about research and development and other expansion costs. I'm sure that was what brought about the long-term liabilities. Okay, so having seen that, we'll see that the company is lowly geared, while the propriety ratio equity holders are a bit below 50% in 2015, but in 2014 they were above 50%, and the debt ratio also shows a total debt of about 22.60 in relation to the capital the company has, and this fairly shows a good performance, in my opinion, from what the company performed in 2014 and in 2015. Okay, so having looked at the ratios calculated and also how to apply the Balanced Scorecard Model, we will now go to Exhibit 2 or Appendix 2 to see how to calculate the marginal costing, the contribution approach, the limiting factor, and the advice the examiner asked us to advise the client on how to go about it. Okay, so having looked at this Appendix 1, the Balanced Scorecard Model, and also the ratios calculated, do we have any questions on the ratios or the Balanced Scorecard Model? Please, if you have any questions, kindly interject so that we can attend to them before we move on. Any questions, please, so far? Well, I believe our silence means we are getting the explanations comprehensively. Okay, so going to requirement exhibit 5, we'll see that from the exhibit we added an information or various information on the type of service and queries that have been received from the call center. Okay, so and that will now determine our calculations for requirement 2. All right, so we're provided with information about mobile telephony, one of the services provided by MNC, mobile internet service, home internet service, and business internet service. Okay, so we want to calculate our limiting factor and our contribution to see what revenue was generated, what costs in terms of variable and fixed were also expended, and which of the services could we rank based on the limiting factor and all the data provided to us in these exhibits. Okay, so going back to the requirement, let's look at the ranking and the calculation of the data provided to us. Okay, so the number of queries are the calls that we received from subscribers externally. So for mobile telephony, we received 2,500 queries in form of calls and complaints. 2,500 queries in form of calls and complaints. And we also received mobile internet service queries, about 1,000. Then for home service, we received about 2,000 queries. And for business internet service, just 250. Okay, so the operator minutes, the time they call per query is 16. You see it on the screen, and it's also provided in the exhibit. So mobile operator minutes per query is 16 for MT. Then for MIS, we have it as 12 minutes per query. Then for home internet service, we have it 12 per query. Then for BIS, we have it 6 per query. So we have two category of staff operating the call center. We have the consultants and we have the operators. So for the mobile telephony, the consultants were not involved in the calls, while they were involved in the MIS for 8 minutes for the consultant section. Then for the home internet service, we have 28 minutes. The consultants attended to subscribers. Then we have 54 minutes for BIS, the consultant attended to subscribers. So it's also worthy of note here that 185 staffs are in the call center, of which 100 are operators, while 85 are consultants. Take note of that. And for those 100 operators, for each hour, or for those that work 15 hours per day, are paid 60 naira per work hour. So 60 naira for 15 hours for each operators is what we calculate as the total hours worked for the 100 operators. And for 85 consultants, we have for 15 hours work per day, they are paid 90 hours per hour. 90 naira, sorry, per hour. 90 naira per hour. So we are also provided with information that both operators and consultants are required to take a mandatory 1 hour break each working day. I'm sure for resting and for cooling off. Alright, so however, with a relative insignificant cost of training, an operator can be transformed into a consultant, and he receive a pay rise, but a consultant can be transformed into an operator with no decrease in pay. Take note of that. Alright, so the cost of the calls, these are the prices per inquiry. So we have 40 naira for MT, we have 220 naira for MIS, for HIS 180, and we have for BIS 300. Okay, so let's perform our calculations based on this data. Okay, so for the operator minutes and per query, we have 2,500 times 16 naira for our MT. So for MT, if you calculate 22,500, which is the number of queries, by the number of minutes, we have 40,000 naira, which is our operating cost. Operating cost in the sense that that's the cost we incur for those complaints based on that. So 40,000 is our total cost of this mobile telephony service area. So 2005 by 16 will give us 40,000 naira. Okay, so how did we get the revenue figure? The revenue figure is the price that we have for the subscriber to call and complain. So there is a cost of that call which comes into us as revenue. So if you look at that, kindly go to the exhibit, you will see the type of service, the price of the call center information. So for mobile telephony is 40. So if you calculate 2,500 by 40, you have the revenue figure. So when you say 2,500 times 40 naira, you have 100,000 naira for mobile telephony, which is the revenue aspect. So the 2,500 naira times this 40 naira for mobile telephony is the price and is the revenue we generated. But also the cost is 16 minutes by this same 2,500 is what we have as 40. So don't forget our formula for contribution is calculated by selling price time minus our variable cost. Or where we don't have those items or components, we calculate our contribution by saying fixed cost plus profit will give us our contribution. So don't forget that formula. So if you do for mobile telephony 100,000 minus 40,000, we have our contribution, which is 60,000. So we have a positive figure or a positive contribution for the mobile telephony service in MNC. Okay, so let's move to the mobile internet service sub area of service for MNC. Now we have the demand as 1,000, then we have the operator minutes at 12 minutes per query. So let's calculate our operating costs, which is 1,000 times 12 minutes. We have it as 12,000, as you can see on the screen, for our operating total operating cost for the MIS. Now for the revenue aspect, we have 220,000, which the cost or the price for MIS is 220, and 220 times 1,000, which is the number of queries, will give us 220,000 naira revenue. So our revenue, which is 220,000 minus our 12,000 operating cost, is going to give us 208,000 contribution. But before we calculate the contribution, don't forget that for the consultant, you will see that there are minutes the consultant also took to attend to the mobile internet service subscribers. So for the mobile telephony, the consultants did not attend to them, and that is why we have a significant contribution of about 60,000. But for the mobile telephony, you see that there was 8 minutes the consultants attended or to their inquiries for that. So out of that 8 minutes, we must calculate the consultant costs also. So 1,000 times also the 8, 1,000 times the 8 minutes that was that the consultant attended to subscribers is also the amount we'll add to the total consultant's cost. Okay, so you can see 1,000 times 8 will give us 8,000. But then, aside that 8,000, you will see that this 12,000 total operating cost, if you divide the 12,000 operating cost by the 1,000 times the 8 minutes that the consultants attended to them, you will see that we have 1.5 minutes difference between the operator cost and the consultant cost. So that 1.5 minutes, if we calculate our 1,000 times 12 times 1.5 minutes, it will give us 12,000. So let's do that again. 1,000 times 8 times 1.5 will give us 12,000, which is the total consultant's cost. So let me take that again. To get that 1.5 minutes, we're going to calculate our 12,000 operator cost. 12,000 operator cost divided by a total of 1,000 times the 8 minutes per consultant's query. It will give us 1.5. So to get the 12,000 for the total consultant cost, we do 1,000 times 8 minutes per query times the 1.5 minutes difference, which is 12,000, the total consultant's cost. So don't worry, I'm going to put this computation and how this total consultant cost is gotten in the Pathfinder, or the suggested solution, for you to be able to calculate that by yourself when you're doing your practice, and also to look at how these figures were derived. Okay, so our total revenue, which is 220,000, less the total operator cost, which is 12,000, less the total consultant cost, which is 12,000, will give us 196,000. So that's for MIS, which is mobile internet service. Our contribution was about 196,000, which is significant. We do the same for the home service. The demand is about 2,000 times the operator minutes that the queries came. So 2,000 times 12, we have it as 24,000, our total operator cost. Now let's get our revenue figure. We have 2,000 times the revenue figure for home internet services on the screen. You can see it is 180. So we have it as 2,000 times 180. You can see our revenue figure is 360,000. So our total operator cost, we have it as 24. Now let's calculate our total consultant cost. And don't forget, the total consultant cost for home service is 28 minutes. So first, let's have our home service demand numbers times our operator minutes, which is 12 times 28 minutes, and we have it as the same 1.5 hours. So the total amount is also 1.5 hours, like in the case of mobile internet service. Now let's do 2,000 times 28 times 1.5. You can see that our total consultant cost is about 84,000 naira. Okay, so for business internet service also, you do 25 times 6, you have our total operator cost. Then 250 times 54, we have 250 times 54 times 1.5, we have it as 20,250. So that 1.5 hours is the across-board amount between the total operator cost and the total consultant cost. Don't get it mixed up. It's a simple calculation. It's just how to understand how to marry the figures together to arrive at this contribution figure. Okay, so back to the contribution. You could see we have positive contributions for the 4 services: 60, 196, 252, and 53.25 for the 4 components of the services MNC provides to the public. So how do we get the limiting factor? How do we get the limiting factor to understand what happened and how this is derived? So we could see for mobile telephony, we have 8,000 as the limiting factor. Then for home internet service, we have 56,000 as the limiting factor. Then for business internet service, we have 13,500 as the limiting factor. So the consultant minutes, if you calculate 1,000 demand inquiry, number of queries times 8 will give us our limiting factor, in the sense that the operators attended to him, but the consultants also attended to him, and this provides our limiting factor between the operator and the consultant minutes. So 1,000 plus 8 is 8,000. Now if you do 2,000 for home service, now we don't have a limiting factor for mobile telephony. Why? Because the consultants did not attend to the subscribers that called for the mobile telephony inquiries. So it's only the operators that attended to them. So where the consultants also attend to them to provide special responses, we have it as a limiting factor. So when you do 2,000 for home internet service times 28, you have it as 56,000, which is our limiting factor for home internet service. And for business internet service, if you do 250 times 54, you have it as 13,500 naira. So we have a limiting factor where the operator attends to a subscriber, but the response is not sufficient enough, and we have additional cost of the consultant attending to each queries per minute, and that is where we have a limiting factor. But where the operator is able to attend to the subscriber seamlessly without any additional input from the consultant, then we don't have a limiting factor. And that is why you can see for mobile telephony, we don't have a limiting factor for mobile telephony. We have it for MIS, HIS, and BIS. So please take note of that. Okay, so having spoken to the limiting factor part of the question, now what is our contributing limiting factor? Our contribution per limiting factor. So we have it as the contribution, which is 196,000, divided by our limiting factor, which is 8,000. So you can see our limiting factor or contribution per limiting factor is 24.50 naira. Now the contribution per limiting factor is trying to tell you that based on your contribution, what limited the factor and by how much in naira is the limiting factor. So please take note of that. So our contribution per limiting factor is our contribution, which is 196, divided by our limiting factor, which is 8,000, gave us 24.50 naira per limiting factor. So we are limited by 24.50 naira based on the mobile internet service. That is what it means. So let's calculate our contribution per limiting factor for the HIS area. So we have 252,000 divided by 56,000, which is our limiting factor, and we have it as 4 naira 50 kobo contribution per limiting factor based on the contribution and the limiting factor for home internet service. Okay, now let's calculate for business internet service, which is 53,250 divided by 13,500. We have it as 3 naira 94 kobo approximately per limiting contribution per limiting factor for the BIS arm of the service area of MNC. So if we want to rank this contributing limiting factor by the highest in Naira. The mobile internet service is the first, which is the highest contribution per limiting factor, while the home internet service is the second, having 4 Naira 50 kobo, while the business internet service is the third, 3 Naira 94 kobo. Okay, so having looked at this, we will see that the cost attributable to the mobile internet service is the highest based on the limiting factor model and our marginal costing approach. So you may look at this as a bit tricky and a bit dicey to calculate, but I'll suggest you practice with it. The examiner is always asking for this contribution per limiting factor question. In the last diet, you see he also tested this contribution per limiting factor in that spicy confectionaries limited. So the examiner likes 100%, this part question. You saw it? Oh, okay. Yes, you saw it, right?
Yes, sir.
Hello, yes, Zach. Yeah. So please take note of this, and I also. Yes, you saw it in the last diet. So the examiner likes testing this contribution per limiting factor. So let's practice and understand the dynamics. Yes. Thank you, AC. So let's practice with this and other questions like the spicy to be able to understand the dynamics on how to approach any limiting factor question, since the examiner likes this area very much. Okay, so this computation, I would put the step-by-step approach in the suggested solution, that's the appendix, for us to be able to understand the tutorials of how to arrive at the computation one by one. So after the debrief sessions, we'll have the suggested solution on this computation for our practice and also our own record. Okay, so the operator minutes and the consultant minutes are just the calculation of the available minutes in total. So for mobile telephony, we have it as 40,000 minutes for operators. And for the other parameters, MIS, HIS, BIS, we have a total of 77,500 minutes. So if we calculate that 77,500 minutes by hour, so let's say 77,500 divided by 60, you'll see that a total of 129 hours was expended based on operators. So for the consultant in minutes, you also see that it's 129 hours attended to by consultants in minutes. Okay, so based on the exhibits, you will see the number of workers for operators and number of workers for consultants. So we have 100 operators and we have 85 consultants. The rate they pay is 60 Naira per hour, and the rate they pay consultants is 90 Naira per hour based on the exhibit we saw. And the number of hours worked for each consultant is 15 hours each, but they have to go on a 1 hour break as stated in the exhibits. So we deduct 1 hour from the break and we have a total of 14 hours for operators and we have a total of 14 hours for consultants. So when you convert this into minutes, 100 times 60 times 14, you have it as 84,000 minutes. 84,000 minutes. Now for consultants, you have it as 85 workers times 90 Naira, the rate per hour, times the minutes worked, 14. You have it as 85, sorry, let me calculate that again, times 90 times 14, you have it as 107,100. This is a mistake here, it's not 71,400, it's 107,100. So if you do for 100 times 60 times 14, you have it as 84,000 for operator, but for consultants you have it as 85 times 90 times 14, you have it as 107,100 instead of 71,400 as stated here, which is a mistake. So you see that for operators these resources are scarce, so this is not applicable. But for consultants, the consultant minutes is not scarce. It's applicable because the consultants answer based on where the operators cannot answer. And that is why the consultant minutes is necessary, because where the operator picks a call and is unable to resolve the challenge with the subscriber, the consultant will be able to attend to that. And that is why this is scarce, but for the operator it's not applicable. Okay, so having looked at that, let's go to the requirements again that the examiner asked us to look at. Let's go to the requirement. You'll see that the examiner said we should advise on how to allocate the existing staff between the two roles, the operators and the consultant, in order to satisfy the market demand, working with the assumption that MNC cannot hire new call center staff. Our advice should also include other business managerial factors that should be taken into account when considering your recommendations. Okay, so having looked at that, let's see practically how to apply what we've just calculated in requirement 1 and 2 in our discussion of findings. So let's see how to apply it graphically in our discussion of findings. So going back to the exhibits, from the financial statements provided to us in exhibit 4, we have the statement of financial position, we also have the statement of changes in equity, and we also have the statement of comprehensive income as a snapshot. So our first component or first area or header we want to talk about is the general business overview for requirement 1. So your header could be review of the strategic and financial performance of the company using Balanced Scorecard Model, or any way you can rephrase that header in summary. You can use that to directly pinpoint you are trying to speak to requirement 1. So candidates should not write requirement 1 as the header. It's not what is the requirement. You are trying to explain to the board of directors the requirement. So you should not say requirement 1. You state what you are asked to do as the requirement. I see some scripts and candidates to write requirement 1. No, it's wrong. So write what you are asked to review or evaluate, which is very important. So under the first header, we look at general business overview, and we can use the financial statements or the general exhibits information there to pick 4 marks under that header. So like stated here on the screen, I said the income statement and statement of financial position provides critical insight into the company's financial health. Now we are looking at the financial performance. We said the income statement shows the company's performance over a financial period, which is 2 years, highlighting revenue, cost of sales, gross profit, and net profit. So for instance, in 2015, we said the company generated 52.28 billion in revenue, while they incurred 431.18 billion in costs, resulting in 91.10 billion in gross profit. So after selling and distribution, profit before interest and tax was about 28.45 billion, while taxation is 9.10 billion, while our net profit is 19.35 billion. So looking at the statement of financial position at a snapshot, so what you are doing, you are just giving a general information of what is on the exhibit in summary form. So we're looking at the total assets comprising of equity and debt, and also the capital for the business is about 354 billion. So the non-current assets is about 257, intangible 40, current asset 35, comprising trade receivables and cash equivalent. We also look at their total liabilities, current and non-current, which is 185.6. Their share capital of 100, retained earnings 68 billion, the total amounting to 168. So you are just summarily speaking to the figures and telling the board of directors or the examiner that this company is solid in financial standing with substantial revenue generation and a growing equity. That's what we are saying. So we use that to pick a mark. Then we talk about the statement of changes in equity that shows an overview of how the equity has evolved over the period, incorporating profits, retained earnings, and other equity movements. So we saw their total equity of 149 billion, 100 billion of ordinary revenue, ordinary share capital, while 49 billion of retained earnings. So we see that during the year, the company made a profit of 19.35 billion, which was added or plowed back as retained earnings. So there were no dividends declared. Now you see that there were no adjustments for the period, meaning that the entire period of that year flowed into retained earnings. Now the result in the closing equity is about 168.42 billion at the end of 2015. Now the prior year saw retained earnings move from 36 billion to 49 billion with a profit of 13 billion. A slight movement or down adjustment of 1.2 billion of prior periods was done, I'm sure, by the company. This shows a steady increase in equity. Also, strong profitability is the result. Prudent retention of earnings contributing to the overall financial health and stability of the company. Now, from the chairman's statement, we could also deduce or say that the company expanded its customer base by 40%, which is an achievement, adding 1.42 million new subscribers. They generated a profit of 19 billion in 2014 and 28 billion in 2015. So the company's innovation, investment in research and development, new internet-based products, key customer service improvements, offering bilingual services, these are all highlighted in the chairman's statement, which shows that the company has a strong brand and a growing customer base and is also well positioned for long-term success despite economic uncertainties. We also know that the company acknowledged, or the chairman acknowledged, the company's employees' contribution or success story, his contribution to his success story. We also looked at the letter from MNC highlighting the key business issues facing the company. We talked about the restructuring and shifting its focus from non-financial performances to customer satisfaction based on the Balanced Scorecard Model. So the company doesn't want to concentrate alone on financial performance. Also, the customer complaints needs to be resolved, and also the company wants to be customer-centric and customer-focused. The company has experienced rapid growth with its customer base. We saw that from 3.5 million to 5 million in 2015. So we can see that the growth has strained its system, and the staff are complaining with lower ratings because of the growth in number of subscribers, but it's not commensurate with the growth in the employment of new staff. And you can hear that the chairman said they don't want to employ new staff, they want to move staff from within or promote from within. Now, despite these challenges, there are these two projects that were successful, delivering strong returns. We also saw the investment in research and development that made the company stay competitive. Now, the training costs have risen due to the recruitment of underskilled staff. The company is preparing for long-term service improvement through innovation and strategic planning. So the staffing issue is an issue we should point out in our challenges and consideration, and also our professional skepticism and ethical issues. So number 5, we found out that MNC is a limited company, is not listed. Now we see that the pressure from the public market scrutiny and other market expectations will be on them to be listed. Now the company's rapid customer growth and capital investments indicate a push to strengthen its competitive edge in the telecom sector. So with plans to be listed in the Nigerian Stock Exchange, Magic Network Communication will face greater transparency and accountability issues because external stakeholders will come in to the picture, and regulatory authorities like the SEC will be coming to Security and Exchange Commission, will be coming to regulate most of their operations. So these are the areas we could just talk about from the exhibits under number 1 header. I'm just talking about the general overview of the business, and we have provide context, and we pick based on our superior achievement 4 marks for this header. Okay, so in the second area, which has to do with professional tools, a model you apply is a professional tool. Ratios you calculate are also professional tools. All right, so we look at the model since the examiner asked us to talk about model analysis. So let's talk about the model first. Then in the third parameter, which is analytical skills, we'll now talk about how to apply the model to the case in question. So let's graphically talk about the model. You know, we drew the graphical picture of the model in the exhibit. So let's talk about the model a bit. Just discuss the model, 4 of them, to pick your superior achievement. So like I said here, I said the Balanced Scorecard Model is a strategic management framework that organizations use to translate their vision and strategy into actionable objectives across 4 key perspectives. We have the financial, customer, internal processes, and learning and growth. This model was developed by Robert Kaplan and David Norton. It's not necessary for you to mention who developed it. I just added it here for your studies and for your own information. The model emphasizes the importance of measuring performance beyond traditional financial metrics, encouraging a more holistic view of organizational success by integrating both financial and non-financial measures. So you are balancing your financial vision or mission with non-financial visions and mission. It allows companies to assess their operational effectiveness, customer satisfaction, employee development, ensuring alignment with strategic goals. So we could see that this comprehensive approach not only facilitates better decision making, but also fosters continuous improvement and innovation within the organization. So I quoted Appendix 1, where the model was graphically painted in the picture. Okay, so number 2, we'll talk about the 4 perspectives, which has to do with the financial, the customer, the internal processes, and the learning and growth. So we talk about revenue growth, profitability, return on investments as financial goals. So once these are positive, the financial aspect is doing fine in the business. While the customer area has to do with customer satisfaction, retention, customer loyalty, market share, quality of service, delivery, and ensure that the organization meets and exceeds customers' expectations. So this is the customer perspective in a snapshot. While the internal processes has to do with internal operations, effectiveness and efficiencies, critical processes that contribute to value creation and ensure it aligns with strategic objectives. The internal controls, the processes that work seamlessly to bring the service to the client very, very easily. While learning and growth has to do with employee development, going for trainings, the innovations, organizational culture, on how the workforce of the company is capable of carrying out the service in a very conducive environment and ensuring that they also continuously improve. So these 4 perspectives enable the balance between the performance, driving long-term success, and sustainability. This is very important. Okay, so ladies and gentlemen, we've spoken about the analysis of the model up to the second point, and it's already 9 o'clock. All right, so on Tuesday we'll continue from number 3, which is the Balanced Scorecard Model we're talking about. We'll talk about the 4th one, then we'll move to the 4th parameter, which is the business model perspective discussion. So let me stop here so that we can rest and also prepare for work tomorrow. So